Welcome to Wise Investors free training on how to produce 9.13% average annual returns for years to come. The simple answer to that question is invest in investments that have already done it repeatedly. So this is going to be a free 1-hour training or so, how to understand and analyze an investment has the ability to actually produce those returns. We're going to use BNY Mellon S&P 500 Index Fund as the example. We're going to cover in just 30 seconds if the investment should even be analyzed any further, how to understand the investment strategy and translate the language in there to where it is something we can understand and also communicate to others, how to understand and simply analyze the performance history, how to quickly analyze and understand the impact of fees and expenses, how to understand and analyze the powerful impact of dividends, capital gains, and distributions. And I'll give you a little bit of training on what those words and terms actually mean. How to understand and read the fact sheet, which is one of the simplest tools that they have available to quickly assess the investment and understand some of the differences and important information inside the summary prospectus, the actual prospectus, the semi-annual report, and the annual report. All this can be accessed along with the free customized investment calculator that we use in this training and the training itself inside of on the website freeinvestmentcalculator.net. So let's get going. All right, so let's get started with the analysis. Jump right to it. What we're on is we are on BNY's actual web page, and I will just trying to make that full screen. And so right off the gate, we see the actual minimum investments, $2,500. So we recommend that you have the available funds to actually do that and not use any type of leverage to get into this type of investment. All right, so why invest in this fund? This is functionally the investment objective that we talked about. On this particular fund, they use a very short version here and then expand it in some other places. So the fund seeks to match the performance of the Standard & Poor's 500 Composite Stock Price Index. To pursue this goal, the fund generally is fully invested in stocks included in the index and in the futures whose performance is tied to the index. The fund attempts to have a correlation between its performance and that of the index of at least 0.95 before expenses. All right, so let's translate this. First of all, it's tracking matching the performance, it seeks to match the performance of the Standard & Poor's 500 Composite Price Index. An index is just a list. So if you think if you write out a grocery list and you write out your favorite cereals, soups, bread, and candy, milk, juice, and all that type of stuff, is a list of items. Okay, that's all. So what you're doing is you're building an index when you use your grocery list of your grocery items that you want to have. Now, if you bought the same items over and over again, then that is a list that you consistently actually use to purchase groceries with, okay? So most of these indexes are lists with businesses that consistently meet the need of some criteria. So a grocery list is grocery items that they're items that are groceries that you're going to buy, so that those things meet the need of what you qualify as groceries. You can also have a list of when you go to For instance, you're going clothes shopping and you're doing shoes and pants. That's a list associated with clothes shopping. So an index is just a list with something that meets a criteria for that list. The S&P 500 is a list of 500 of the largest businesses in the US, okay? And they set out criteria for the actual businesses to meet that standard. So the index, the S&P 500 is a list of the 500 largest businesses in the United States. An index is just a list in general. So what we're doing is we're saying that the S&P 500 index is a list of the 500 largest businesses, measured specifically by some certain criteria. 2% gold, the fund generally is fully invested in stocks included in the index, okay? So they're just matching the list and investing in that. Now, and in futures whose performance is tied to the index. So they're also doing a little bit of maneuvering and investing in a different type of investment that's not is directly associated with the actual index, but a slightly different type of investing. But with this, the fund attempts to have a correlation between its performance and that of the index of at least 0.95 before expenses. So what they're projecting is 0.95. If you think about one being 100%, and 0.95 is 95%. So basically, they're trying to match the list by 95%. Simply put. All right. So wrapping this up, they want to match the performance of the S&P 500 composite stock price index by 95% before expenses. So that's a way. What we did was we quickly understood that this is an index fund, what that actually means. We quickly translated what they're actually trying to accomplish in there. And then one of the last things is they told us they're actually trying to match it by 95%, which is actually a critical component. We do not want them to vary off of the list much. The more that people make decisions with lists that are actually perform well, index funds, the more they vary off of it, the more you're going to have surprises and is going to perform in erratic ways. So we want our index funds that we invest in to actually be very close, if not 100% of the actual index that they're trying to match. So let's move on to the average annual returns. Now, one thing I told you is that in order to invest in something that has that you have the confidence that it will produce 9.13% average annual returns going forward, is that it has done it in the past. So this particular one was produced back in 1990, January 2nd to be precise. So as of today's date in 2021, it's been around for 10, 20, 31 years. And over a 31-year period, it has produced on average 9.77%. So it's been doing it, and it's been doing it repeatedly, okay, since inception for over 30 years. That's rock solid. All right. Now, the next component is what it's doing more recently. Now, we raised the standard for what we're looking for recent, and the standard that we put in place is actually 12.54%. So what we're looking for in the 10, the 5, the 3, and the 1 is for each one of these to be 12.54% or better. So it's rocking and rolling in each one of these categories. So we have since inception of 9.13%, 31 years, killing it. 10, 5, 3, and 1 of 12.54% or better, killing it. All right. So powerful, powerful actual index fund. Very, very good. So now what we do is we're going to go down to, this is the most common way to look at the investment. If you put in $10,000 in, we're going to use our calculator to kind of explore this in a more realistic fashion. Most people are not going to start off with $10,000. Here's something I want to really kind of highlight, and this graph shows it, but I want you to see it in the numbers, okay? So since 2011 was not the greatest year. It's 1.65, but yeah, 15, 31, 15, 0.91, 11.35, 21.26, negative 4.88, 30.87, 17.77, and it's currently killing it because it's at 55% growth in 2021. Now, here's where I want to emphasize in this journey. Over this particular 10-year period, it has been killing it for 8 of them. It did just above in 2011, but 1 year it had a tough year. What I don't want you to do is discount all of this because of this. What happens is if you're measuring your investment by the day, by the month, or even the quarter, and even in this perspective, you know, the year itself, then what you could be missing out is on this. So don't jump off the ship because of one bad year, okay? If you're investing in something that has a 30-year track record of killing it, and it has one rough year, don't abandon it. So we want to have the confidence when we're investing, because of these other things, that we don't jump off the ship when it has a rough year, okay? So let's get down to a couple of things. One is, now we're talking about the expenses. Now, the expenses are not going to go into detail about all of these, but basically functionally, the management expenses, the cost of actually doing the business, you got service fee, other, and then you have your grand total here of 0.51, and then some of this getting reimbursed. So your net expenses is what we pay attention to at 0.50. Now, the expenses on this is actually a little bit higher than I would like for an index fund, but it's not too high. Our personal standard, this meets right at the threshold of 0.50. So this is high as we want to invest from our personal standard and what we teach people to do. And I'm gonna show you in the actual investing calculator the impact of making that type of decision. So if you wanted to take a look in what's inside this type of index fund, it gives you a breakdown of the industries that are inside now, and then they actually should have I'm sorry, I scroll past it. If you want to take a look at the specific investments that's inside of there, that piques your interest. If you're really concerned about what they're actually investing in, you can analyze that as well. I do not, and I recommend you do not look at the daily. We're investing for the long term, because that's what investing really is. So therefore, the daily ups and downs, we do not watch those, because they will cause panic. All right, they will give you heart palpitations. All right, so let's talk about the dividend schedule and the distributions, okay? So how I like to teach dividends is, if you think about if you're investing in a real estate property and you want to use it as rental property. So if you're investing in rental property, you're expecting a traditional one where you have someone living there, and you're expecting monthly rent, okay? So as a result, every single month you expect, $500 in rent, $2,000 in rent, whatever it looks like. And that income stream is the reason why you're investing in this thing, okay? And it is absolutely critical. Now, dividends are functionally the predictable income stream from investments. All right. So inside of this particular investment, it has a predictable income stream that's going to come from it. The actual dollar amount will adjust up and down slightly over time, but it's a predictable stream of income. Okay. It might not be $500 every month. It might be $400 one month, $700 the next, that type of thing. This particular dividend schedule is actually annually, okay, so once a year, and it's on October 31st. So once a year, they're going to give you one lump sum check. So think about it like your tax return, except for this is earned. Well, this is income, not a return on something you overpaid. So dividend is income. Capital gains is if I sold something inside of it. Okay, I gained capital. Okay, so inside of these investments, if they buy and sell and make a profit, then they pass on the profit to you. That profit is capital gains. Okay, those are both good and okay. Dividends come with taxes because that's income. Capital gains come with taxes, so that's income. Dividends have a better tax treatment than capital gains do, but nonetheless, the capital gains will pay for the taxes itself. So never look at the taxes associated with dividends and capital gains as a major factor, because you can use the capital gains and the dividends to pay for the taxes. You take no loss. So we're going to plug that into our investment calculator and look at that over the long term and see how this combination of dividends and capital gains, how they impact your investments going forward. Now, when you combine dividends with other things like capital gains, the term is now called distributions. Okay, so distributions is a combination of dividends, capital gains, and maybe even interest income from like bonds. Okay, so now we have our distributions history, which is now shows you exactly what I said. You have some dividends, you have some qualified short-term gains, some long-term gains, and then you have a total distribution on the back end. Then it tells you exactly when you're going to receive your money, right before Christmas. Hallelujah. All right, so we have covered the investment strategy, the performance, fees and expenses. We touched on the portfolio, which you can go back and dig into if you want to go back into that. Really didn't cover stats and risks. The reason is when you analyze an investment from a long-term perspective, a lot of times their analysis of stats and risks doesn't really correlate with actual risk. So if you have an investment that's been cranking it out for 31 years, it has gone through a pandemic, it has gone through an oil crisis, a mortgage crisis, it has gone through the dot-com bubble and burst, it has gone through a real estate bubble and burst, it's going through the great bank bailout, it is going through the fear of 2000 Y2K. It is going through a lot and still got it done. So it's been through a ton of different crises and still cranked it out. That within itself lowers your risk. So I don't necessarily look at those stats and risks that's usually in these type of things, because the way we analyze at the beginning nullifies those types of risks. So let's hop into the fact sheet. The fact sheet is probably is one of the simplest ones to actually analyze, because functionally is actually just a general summary of what we already have looked at. Okay, so this particular one was produced in December 31st. So you qualify the information on there based on its accuracy and up-to-dateness. But it's basically a summary statement. The website is going to have actual up-to-date, up to that moment. All right. So it's going to have the same growth of 10,000 historical performance. It has highlighting that bad year 2018, but it also is graphing you up to see the others. Down here, you're going to have a different vantage point. Every fact sheet is going to be slightly different. This one takes a side-by-side comparison of the individual businesses and also the actual sectors and industries that are and how they're proportionally invested inside of this index fund. Now, one of the things that's unique and actually very nice inside of a fact sheet is it expands the explanation of the investment objective. So it goes into the fund seeks to match the performance of the Standard & Poor's Composite Index. Spiritual Gold Fund generally is fully invested in stocks included in the index and in futures whose performance is tied to the index. The fund attempts to have a correlation between its performance and that of the index of at least 0.954%. A correlation of 1 would mean that the fund and the index were perfectly correlated. So it further explains the approach. Okay, so that's actually a great way. If the summary on the website doesn't feel like it explained it better, you can hop on the fact sheet and get a better explanation. They have all the source material and things like here down here, and you can take a look at. But so let's hop over to the summary prospectus. Now, the summary prospectus takes the investment, the fact sheet, and expands from there. Okay, so now you're getting more information on the fees and expenses. Is explaining the expenses a bit more, is giving you an example of impacts of the expenses. It's talking about portfolio turnover, which is actually very important. Portfolio turnover is how often they buy and sell inside the investment. This is critical because you pay for the expense associated with it and the taxes that are produced from it. So a low turnover rate means that it's going to lower your overall expenses and lower your overall taxes that's going to need to be paid. This particular one has a 2.43% average on turnover, which is fantastic. We love to see 10% or lower. Principal investing strategy. Now it takes the investment strategy and it expands it even further. So now you got, it's talking about the fully funded, explaining that a little more. The S&P 500 is an unmanaged index of 500 common stocks chosen to reflect the industry's economy and is often considered a proxy for the stock market in general. S&P weights each company stock index by its market capitalization. Market capitalization is, in the simplest way, is the size, so how large it is, the share price times the number of shares outstanding, adjusted by the number of available float shares. Those shares available to public investors. So it's going to more information about what that really means. Companies included generally must have market capitalizations in excess of $98 billion. So this gives you the standard, the general standard of what you have to qualify to in order to even get on the S&P 500. So now you get more information about what that means, and goes down to more risk and talking about that. Performance, it's going to give you a bit of a different look, 1, 5, and 10. Then you have portfolio management, purchase and sale of funds, the impact, tax information. So now you're getting into some of the more granular details associated. I would say 99% of the time, the summary prospectus is probably going to be the one that's going to give you all the information that you want or need. But if you want to go deeper, you can go into the prospectus. I don't usually recommend it because the prospectus is going to give you a broad view of every index fund or related fund for this particular family of funds, okay? So it's usually not needed, okay? But you may want to do that if you want to go down and actually see their whole general approach and have a broader view of this particular investment firm. Now, the semi-annual report is going to be a more of a conversation, and they're taking information from different people who are vested in making decisions. So a letter from the president, a discussion of the forum, understanding. So you're going to go deeper into your fund expenses, comparing your fund expenses with those of others funds, so you can get a different analysis of that. Then you go into just more information of the futures, what that really means, what they're actually doing. So you can go deeper into that. And so that would actually be a good difference that's inside the semi-annual and the annual report. Operations, changing net assets, you know, what are they doing? That's a turnover basically inside of their financial highlights. And so you can dig deep into the semi-annual. Then you have the annual, which is the big dog, and it's going to basically flush out the same things, except now you're going to take a longer view of them. So instead of going over from a 6-month perspective, you're looking at it over an annual perspective and a longer view. So that is functionally it. Now let's go ahead and apply this information into the calculator. Now we have an understanding and see what happens. So it takes $2,500 to even get started. So let's use an example of you using or just putting in $100 a month after that, okay? Now we use the lowest previous annual market value growth, and let me double check what it is currently, because this was dated information. So that's actually 9.77. So let's plug that into the equation. We're using the inception date is typically going to be the most accurate information on that. The actual price to actually buy this particular investment and is down here somewhere. I'm really sure. I'm like at least 40% sure. 57.85. All right, so let's get some accurate information. 57.85. Annual distribution is one time a year, so that hasn't changed. Expense ratio, we covered that at 0.50. Current annual distribution yield, I won't necessarily teach that at the moment. I'll go into that into another lesson. 10-year average distribution growth of 6.54%. This information I will actually have, I will give this to you. So as an example, with the actual sheet, it has all this. You'd have to update this if you want this to be accurate, but here's your annual distribution rate. Here's your 10-year growth rate. So I'm giving you that information so you don't actually need to try to figure it out, okay? All right, so we have that in there. You don't have to try to figure it out. I'm gonna give it to you. And so here's down here is the impact, okay? A couple of things we're gonna look at. One is, so year one, you've invested $2,500 plus $100 a month, so it's $1,100. So you got $3,600 invested, and so you had a $340 gain for the first year. And with the income side, this is the distributions, $334 in distributions, okay, for the first year. Year 5, you've invested 15, well, you have growth of 15,486. You got this popping out in distribution income. And this is every year. This is not up to that point. So at year 5, you are now at, so it grew from here to here over a 5-year period. At year 10, you've grown to 47 and at year 10, you're producing $3,000 a year in income. Year 20 is where it pops up at 273, 16, 1.9, 1.19, 53. And 40 years from now, you are a multi-millionaire. So at 30 years, you hit the millionaire mark. Well, actually before that, you hit the millionaire mark, and then at 40 years, you're at a multi-millionaire. Now, this is at a one-time investment plus $100 a month. Let's test and see if I never invested another penny in this. So if I did the one-time investment, in 40 years, you're a millionaire, and it's producing $41,000 in annual income. Not too shabby. If you're add on $200, this is where you can test the calculator. Not too shabby. 30 years from there, you are a multi-millionaire. So somewhere between 20 years and 30 years, you became a millionaire at $200 a month, plus on top of the initial investment. Not too shabby. Say, for instance, you decided I wanted to add my tax return in there instead of go spend it once a year. So pretty significant impact. So you play around with this, and it gives you the ability to see the impact of decisions that you can make that will impact you in the short, medium, and long term for the next up to 40 years. So not too bad. One thing down at the bottom that's we've put in here is so you can get just a quick look of what this means. So total dollars invested, $2.5 million with walkout money of 7.7 million. So not too bad. You invested the 2.5 million, and that produced $2.5 million in income. Not too bad. Now here's the impact of expenses, and I'm gonna play with this figure just for a second so you can see it. It says total expenses paid, and this is over a 40-year period, of $304,000. And you invested in a traditional mutual fund that had a 2.00%. You would, over that 40-year period, you would pay $1.2 million. So more than 4 times the impact from 0.50, because it has a greater impact over time because the fees are based on this balance. So as your balance grows, so does the fees. So if you have a particular investment that is, Let's a little quirk in there, 0.25%, you got a nice little jump down. So it's measurable impact from a lower fee, measurable, and it's even greater the longer you have it in the actual investment. So that is a way to analyze an investment. We use a particular index fund, BNY, Mellon, S&P 500, and we walk through each one of those components, and then we use a calculator, this customized calculator, to actually give a more detailed analysis of it. Now, so that is the end of this particular training. If you have any questions, feel free to hop over to our Facebook group. I'll have a link to that on the website, which is found at www.freeinvestmentcalculator.net. I hope you have a blessed day, and talk to you soon.